Alan, we've had some interesting news today. Total, the French oil major, has disposed of its interests in two North Sea gas pipelines, the Fuka pipeline and another one connecting Gasfield with Shetlands, and also a big gas terminal in Scotland. They've raised $900 million with this deal. What's going on here?
Well, I think this has probably been a planned deal for some time. My sense is that Total is just, farming down. It's just sort of reducing its interest where necessary. The CFO has said that, they've been trying to reduce, raise money where they could. So I don't see it so much as an exit for Total, which is one of the largest producers in the North Sea. More of a, just a way of optimizing their assets.
So financially, I mean, they have a huge balance sheet. As you say, they're one of the biggest operators in the North Sea. They've talked about a $10 billion disposal program. What does that disposal program, what is it designed to achieve? What is it designed to achieve in terms of dividends, in terms of cash flow?
Well, I think in the case of Total, they will be just trying to make sure that they have enough money to meet the growth prospects and the dividend for the company. But what I think is really interesting, actually, is not, the big guys have a good balance sheet. What's happening is in the North Sea, we're starting to see, private equity companies in the last year or so are looking at the dropping oil price, hoping to see not just that a Total or a BP might sell them some assets, but maybe some of the smaller players that might be more distressed.
So could this deal perhaps herald a wider wave of consolidation across the North Sea and elsewhere?
Well, you would think so, but I think you need to be a bit cautious about expecting a whole bunch of transactions. In the first place, operating costs per barrel in the North Sea, UK North Sea, are very high. UK operating, the cost of operating in the UK are more than double what they are on average in other oil-producing countries, right? Roughly $28 per barrel.
But I mean, you could argue this is the perfect time to get in. It's a low oil price, right for consolidation. We've got private equity groups, Carlyle, CVC Recruiting, Sam Laidlaw, ex-Centrica, to come in with €5 billion fund to go and spend money.
Exactly, but it's expensive to operate there, right? And a number of the smaller players that you might hope, if you're a buyer, would be distressed and ready to sell up. They have improved or increased their credit facilities over the last 6 months. They've been preparing. They've hedged. EnQuest is 75–80% hedged for this year and next. EnQuest is a UK-listed E&P company with a specialization in the North Sea.
So you would argue we need to see a good deal more distress
I
first?
think so. I think we're not at the point where there's true distress, right? On top of that, it's expensive to operate there. You better be more than cashed up. You better be ready to take some time at this, right?
Let's play fantasy oil price. At what point do you think we will see the kind of distress occurring where private equity groups start to get a nose in?
I would guess, in my opinion, we'll need to see the financing wear away, the hedging wear away. I think we need to see the oil price not just a bit lower, but possibly just low for a while. So I would start thinking about next year rather than, don't worry about this year, late next year, maybe 2017.
2017. So $40 a barrel, consistent price. That's the
maybe
point at which
$30 a barrel.
Well, that's where we saw it back in 2009 briefly, I think, wasn't it?
Yeah, but
so
only briefly, right?
Only briefly, and it rebounded. I think this is different this time, though. We have a fundamental oversupply in the market.
I think so.
Thank you very much.